Hey, everybody, welcome back to the show. Today's guest is Sequoya Borgman, founder and CEO of Borgman Capital. After advising on hundreds of mergers, acquisitions, restructurings, and financings at firms like KPMG and RSM, Sequoia launched Borgman Capital to invest in founder and family owned lower middle market businesses. His philosophy is simple but powerful. The best investments begin with trust, shared values, and great people. Today, we're talking about private equity, entrepreneurship, culture, and what it takes to build a lasting enterprise value. Sequoia, welcome to Capitalist Culture.
Yeah, thanks for having me on the podcast.
No, absolutely. My pleasure. Yeah, well, maybe we'll kind of get into it. I mean, your career began in public accounting before, evolving into M&A and ultimately private equity. What, kind of first drew you into this world of deal making?
Yeah, but my background's a little different than most private equity comes out of investment banking. I started out actually with Arthur Andersen out of school. I went to college and grad school for accounting. Started out with one of the big five at the time, and yeah, really got introduced into the M&A and transactions through that. Kind of on sitting on that side of the table. Worked with a lot of private equity firms all over the country. Did that for about 20 years. Made to partner, and really had a great time. But I was looking to do something a little bit more entrepreneurial, and working with a lot of the lower middle market private equity firms around the country. Just really enjoyed what they were doing, and was good friends with a lot of the individuals at different firms, and saw an opportunity to launch a firm here in the Midwest, and did that about a decade ago now. We're coming up on our 10-year anniversary
Huh.
here. And yeah, haven't looked back. It's been a lot of fun. I actually wish I'd done it earlier in my career, but 20 years of experience in public accounting really helped with what we look at. So yeah, that's how we got here.
No, absolutely. What I mean, kind of looking back on those times, in public accounting, any experiences that particularly shaped the investor that you've become today?
Well, I mean, accounting is the language of business, so you
Right.
can analyze a company in a couple minutes if you look at their cash flow statements and really look at the health of a business. And we look about 1,500 businesses a year. So, I mean, I think having that background where you can really quickly um, decide if it's something we want to dig in on and spend the time and the money and the effort to really go after, or if it's something that we can pass. I think that's really good having that accounting experience. Really, I mean, like I said, it's the language of business, so it helps you analyze whether or not it's something that we want to go after. And the leverage buyout model kind of that we work with is all based on buying businesses with strong, steady cash flow.
Mhm.
And you can really tell if a business has that potential based on their cash flow statement and their balance sheet and income statement and their financial statements.
No, absolutely. I mean, you've done hundreds of acquisitions, restructuring, financings. Maybe what's the biggest lesson you've learned that most first-time buyers completely miss?
Yeah, I mean, people think it's all about the numbers, but it's really about the people. So the
Sure.
biggest thing is just evaluate the owner of these businesses, evaluating the management team, or if we're bringing in a new management team, really evaluating that individual. That's the biggest driver of high returns in this business is really having strong leadership. It's all about culture and leadership and taking care of your people and that's the one thing that people probably underestimate. They spend more time on diligence and looking at numbers and risks and all the other underlying factors that go into a business. But I'd say 80% of the success is due to who's running that business and who's in charge and who's really leading that organization.
Yeah, maybe what's the I don't know, maybe the most difficult transaction you've had to deal with and maybe what made it so challenging.
Yeah, I'd say all of them have different challenges. The easier ones are when the transition goes very smoothly from the founder or the previous owner to the new CEO. But we've had plenty of rocky starts. We've made poor hires on who we're going to replace the founder or the owner of the family with, and we've had to make those replace that individual in a short period of time. That's never easy, and it sets back our investment 6, 12, 18 months when you have to
Sure.
make a change like that. It takes a while for a new leader to get up to speed on a business or a company. So that's probably been the biggest mistakes we've made over the last decade or so.
Yeah. And that kind of really leads into the next question, which is when deals fall apart, is it usually financials or is it, as you just kind of led there with the people?
It's the deals that don't close is usually financials. There's
Okay.
something that comes up in diligence. We do pretty deep diligence around financial and legal and environmental and all the normal customer diligence, you name it. And I'd say the ones that don't get over the finish line is because their numbers don't come in line with where we were expecting, and that's probably the number one reason a deal doesn't close.
Okay. And you focus on, as you said, I mean, on founder-owned, lower middle market businesses, an area that like most institutional investors overlook. Why was that your focus?
Yeah, I mean, we feel like that's probably a less competitive area of the market. Like you said, a lot of the larger private equity firms around the country are going after the middle market or larger businesses. All the businesses we've invested in are under 150 million in revenue, under $20 million of EBITDA, and they're all family or entrepreneur-led businesses. And that's an area that some of the bigger firms just don't want to go through the heavy lifting of professionalizing those businesses. And there's more risk too. They lower cash flow, more risk. Banks don't love them as much, and you don't put as much leverage on those businesses. There's a lot of factors that's less competitive, but you can find really nice businesses in that area. Businesses that have been around two, three, four generations, really nice proven business models. They just haven't grown as much as some of the bigger companies, and you can find really nice opportunities, and it's fun talking to those entrepreneurs about how they started those businesses. You always hear about the business that was started in the garage or the basement, and 90% of the time that's true. Some entrepreneur took a risk at some point and started from scratch and grew a really nice business, and we love talking to those entrepreneurs and getting up to speed on their business and buying those types of businesses.
Yeah. Yeah. And in your firm, I mean, Borgman Capital emphasizes partnership over ownership. So how does that philosophy influence the companies you acquire?
Yeah, I mean, most of the businesses, the owners are rolling over a big chunk of equity, staying involved, either sitting on the business on the board or continuing to run the business for a period of time. So it is really a partnership. So half the valuation is really how well we're going to work together. Our interests align, our vision for the business aligned. To what the owner wants to do with the business, is it really what we need to do to get the returns that we need to get for our investors? Those, if that aligns, then those are the best investment opportunities.
Yeah, one of the biggest criticisms private equity gets is, they're too focused on financial engineering and not enough on people. How do you think about culture when you're evaluating an acquisition?
Yeah, I'd say some of the bad rep that private equity gets from financial engineering, a lot of that's from the 80s and 90s, all
Right,
the
right.
barbarians at the gate and stuff. It takes a long time for those reputations. There's very little financial engineering these days. You really have to create value. You really have to grow the business. You really have to either do some add-ons. But from our standpoint, I mean, culture's number one. I've read somewhere that a culture in a business is established within the first 6 months of that business being founded. I mean, it's really around that founder,
Uh-huh.
and changing a culture is extremely difficult. So if it's a poor culture, I mean, those are not great investment opportunities, because even if you bring in the best president or CEO or leader for that business, it's so difficult for them to change one culture to another. So when we buy a business, we do cultural evaluations for the new leaders and make sure that their culture really aligns with that business. That's a bigger factor and bigger determination of their success in that business. If they fit first Maybe they came from a better culture, but they tried to change that culture of that business. That's just extremely difficult to do, and unless you want to replace the entire management team, which
Mm,
again, that's a huge risk to do that.
for sure. How about when you're meeting with a founder who's built a business over decades? I mean, how do you really earn their trust?
Yeah, it takes time. The best deals, we don't go after a lot where there's like a blind auction process because you
Mhm.
don't get to know that founder as well. You're not able to build that trust. A lot of the deals and companies we buy, we've known that owner for years, and we're there when they're ready to transact or sell or step away from that business, and we've built up a relationship over 6, 12, 18 months. It's not something that you do over a management meeting or one or two dinners. It takes a long time. You have to trust each other. But a lot of times sitting across the table from somebody, you can really just tell if if their interests are aligned, if their values are aligned. I mean, we take care of the employees and the communities and continue the charitable givings that the founders have. If that's part of what that owner was already doing, then our interests are aligned. If the owner's really just focused more on what's in it for them and getting the highest price for their business, that might not be the best fit for us.
Uh-huh. How about what do you think separates like great private equity firms from average ones?
Well, it's not easy for any of them. So I'd say the ones that have been around 10, 20, 30 years, they're doing something right. There's a lot of competition out there. There's a lot of firms, new firms popping up every day. It's extremely difficult. Managing one business is very hard. I mean, very lumpy, as anybody that owns a business knows. Imagine managing 10 or 12 or 20 or more at the same time. There's always some challenges you're facing, something you're unexpected. And a lot of times it's people issues. I mean, I'm always surprised. I get calls at all times of the hours, and it's some crazy thing that somebody did at some company that you would never expect. So I'd say that the better performing private equity firms, they've learned a lot of lessons the hard way, and they've made it through those challenges, and they've been in there for the long run. And there's a lot that don't make it because yeah, they have some challenges that they're not able to overcome kind of earlier in that life cycle of the firm.
Yeah. How do you think about preserving that entrepreneurial spirit after the acquisition?
Yeah, it's really difficult. That's a great question. There's nothing like an entrepreneur. They're always a little off for some reason that makes them successful.
Right.
But then when you bring in a new president, new leader, they're usually more kind of a professional manager, professional business person. They have an MBA and all the business knowledge, and they're more focused on kind of the margins and revenue and productivity and all the stuff that you need to be focused on, but it's less entrepreneurial, I'd say, for
Uh-huh.
which is not necessarily a bad thing. A lot of entrepreneurs kind of tap out at some point. They're really good at maybe R&D or engineering or sales, but they can't really do it all. And that's why a lot of these businesses tap out at 20 million in revenue, 50 million in revenue, 80 million, whatever the number is the entrepreneur sometimes holds that business back. And so when you bring in a professional manager, maybe the business is less entrepreneurial, but it's able to scale more and really get that business to the next level.
Yeah. How about, when you're kind of looking in, when should an investor leave management alone and when should they step in?
Yeah, I mean, management is there to run the business. I mean, investors aren't there to micromanage management or run operations. I mean, if you I always say if I'm having to tell a president how to run that business, we have the wrong president. Because like we discussed, my background's accounting and finance and doing deals. It's not running production on a production floor or dealing with HR issues, all that kind of stuff. If I'm having to really push a president or we have a value creation team as well. If they're pushing a president to do something that they should be doing, we probably have the wrong president leading that company. So that's probably a number one factor. But I'd say as an investor, our role is really fiduciary, doing what's in the best interest of our investors. How do we drive value? How do we increase the enterprise value of that business? What risks do we need to really watch out for, and long-term strategy? Because the presidents and the management team, a lot of times they get stuck in the day-to-day, just operational challenges of that business, and they don't step back enough to really think about big picture and driving strategy. I'd say that's more our role than being micromanagers.
Yeah. Hey, friends, Kip here. Before we jump back into the episode, I want to share a lesson that has cost businesses millions of dollars. The most expensive mistake I've seen, hiring the wrong leader. Not because of the salary, but because of the lost momentum, missed opportunities, and the time it takes to recover. That's exactly why I founded Kip Search. We help private equity firms, family offices, and venture-backed companies, as well as founder-led businesses, identify and recruit exceptional executive talent that fits both the role and the culture. If you have a critical leadership hire on the horizon, I'd love to have a conversation. Visit Kip Search, KIP Search.com. That's KIP Search.com, or click the link in the show notes below to schedule a recording strategy call. Now, let's get back to the show. How about for founders thinking about selling? What should they evaluate beyond just purchase price?
Like again, a lot of times these lower middle market businesses, they're going to be involved for the long term. They're either rolling over some equity, they may have a earnout or a seller note. So, and most of these founders, they care about their employees. They don't want their employees to lose their jobs. So I'd say that the founder really needs to look at somebody that's aligned, that they see that is going to take care of their business. That's really going to be a steward of that business. Again, take care of the employees, take care of that community, continue to grow that business. Some of these businesses took 80, 100 years to get where they're at. They're in a 2 or 3 year time period. I mean, there's not going to be as much value that's built in that was built over that 80-year period. So, I mean, we're not flippers like some firms. We're
Sure.
not selling companies in three years. I mean, we're more of a longer term investor, and I'd say founders that are thinking about their employees in that business. You have lots of options because you don't have to sell to private equity. Maybe you get the highest price from private equity, but you can sell to your employees. You can do management buyouts. There's ESOPs. You can sell to strategics. There's all kinds of options for these founders. So I'd say really look for somebody that you're aligned and that you feel like is going to take care of what you've built.
Sure, sure. How about what do you think is, maybe some of the biggest mistakes that owners make before taking their company to market?
Yeah, I see it a lot that there's a lot of ways to create value in a business before you go to market. I mean, address a lot of the risks, address a lot of the stuff that a buyer's going to ding you for, all the stuff that's going to come up in diligence. Make sure you address that. Anything you can do to improve your working capital, that's additional cash in your pocket. And you can't do that a month before selling. You have to do that a couple years before selling to show that the business really doesn't need that working capital to run. If there's anything that the seller's doing, I mean, the biggest thing that these businesses are dinged for is seller does a lot and they're hard to replace. So if they're doing 3 roles and you have to hire three people to replace that seller, I mean that EBITDA is going to be dinged for that cost. Where if the seller goes ahead and hires three people to really take over those roles, and the seller's already stepped back a bit before they sell, they're going to get a better value and a better price and a higher multiple for that business if they've really addressed the factor that, I mean, the bigger the a component that the seller is in that business, the lower the multiple that they're going to get.
Mm.
So as much as they can replace what they're doing, that's going to improve the value of that business as well.
Yes, absolutely. How about, when you're doing your diligence, how do you determine whether the business has the leadership team that's really capable of scaling?
Yeah, it's difficult. I mean, we spend a lot of time with them, but you really don't know till probably 6 months after you buy a business how good that management team is because yeah, you have to work with somebody. It's no different than if you're hiring somebody. A lot of times they look really good on paper, they interview really well. You go through all the assessments and maybe you get the board involved in a hire and you don't know how they're going to work out till a month or 2 or 3 months down the road. And that's very, very evident if you've made a poor hire or not. It's no different when you're evaluating a management team. I mean, you can see how their performance has been over a long period of time. That helps. It's not like when you're hiring somebody, you don't really know. I mean, you do the reference checks and everything, but everybody says good things. Nobody
Uh-huh.
ever says poor things in those reference checks. You don't know their real performance, but we see all the numbers. So that's one way to evaluate management team. If the company's doing well, the management team must be doing something right.
Yeah. How about, for your firm, you've built your firm around relationships, trust, and shared values. Why has that become such an important differentiator for Borgman Capital?
I mean, it's all about our network. I mean, all the businesses we've invested in, we've been introduced through somebody in our network, and I mean, people need to trust and know that you're going to do the right thing by them and by the businesses, and that's very, very important in this business. And that's why we've got 5 offices around the country. We're in kind of second tier cities where networks and relationships and kind of your reputation really matters. And if you're in those cities and you're networking with your or talking to your neighbor and they may introduce you to a business owner that's thinking of selling, or you go to church and somebody at church is wanting to sell their business, that's how you find the best opportunity.
Mm.
It's where you're going direct, you can build a relationship, you really trust that individual, and that's really been our focus from day one is buy really nice businesses. We don't invest in turnarounds or restructuring or anything that's not doing well. We invest in really nice businesses, and we try and maintain and keep going what they've built. That's really our MO.
Yeah. How about, to the extent you've thought about this at this point in your career, when people are looking back on your career and what you've done, what do you hope they remember about the way that you've invested?
I hope that they really say, I mean, one of the thing I really emphasize with our team is do what you say you're going to do. And I
Mm.
feel like that's one thing we really, when we tell a seller we're going to close a deal or we're going to do something, we do that. It's not always difficult. I mean, some mistakes happen, things pop up, but if that happens, you make it right. And that's kind of, I hope looking back, people will say that we did what we said we would do. And that's really kind of our legacy as a firm.
Yeah. How about, what do you think, the responsibility that, what responsibility do you think the private equity firms have to employees, communities, and then the families behind the companies that they acquire?
I mean, there's clearly deals that don't go well in private equity, and nobody wins, and the employees lose worse than anybody. I mean, that's their livelihood. They're taking care of their families through those things. But there is no private equity person out there that is not trying to get a really nice return. And the only way you're going to get a really nice return is if that business thrives and grows and you create value and you take care of those employees and you actually hire more employees and grow that business. Everybody hears about the bad bad deals or the ones that don't go well and how that impacts employees. But that's not the intention going in for sure. Everybody out there is trying to make a really nice return on their for their investors, and the best returns are when those businesses do really well and the employees do really well. And every business we buy, we set aside a chunk of the equity for the management team and employees that are creating value to earn. And that's a differentiator. That's huge for some of these employees. I mean, we've sold businesses where employees have made life-changing amounts of money. Where they didn't have that opportunity when it was a family business or founder-led business. So because their interests are aligned with us, they're the ones that are creating a lot of the value. They should share in a lot of that upside.
Mm, mm. How about on the topic of leadership? How has your personal definition of leadership evolved over time and even as the business is growing here?
Yeah, I mean, again, it really depends on the business, and that culture and what type of leadership that business means. I mean, I feel like being a servant leader, lead from the front, not from the back. That's really never changed. But the businesses, each type of business that we invest in, each different business is different. Each culture is different, and you really need to evaluate what's best for that organization, that type of business. Maybe it's a manufacturer or a distributor or some type of service business. All those need different types of leadership. And you really need to evaluate what's best for that particular investment.
Sure, sure. How about is there one, particular leadership lesson that you've learned that's proven particularly valuable in your life?
Yeah, I don't know if I can put my finger on one at the moment, but like I said earlier, just do what you say you're going to do. Be open, honest with people and with your employees. I mean, nobody. Um, I mean, that's the best advice I've ever got. I mean, bad news. You have to share bad news. Don't sit on it. That's the number one thing I always tell our presidents. If something not good is happening, I want to know immediately. And or anybody that works with me, that's not something, and I share that news immediately with our investors if it's going to impact their investment. Good news seems like that bubbles up a little bit slower, but I like to hear good news as well. But that's the main one is be open and honest, tell the truth, do what you say you're going to do.
Yeah, yeah. How about can you discuss your approach to when the time comes to attracting and retaining high performance leaders within either your firm or within your portfolio companies? How do you find those rock stars and get them to stay?
Yeah, I think the people that are attracted to private equity and to leading private equity led companies, they're all have an entrepreneurial side to them. They're risk
Mm,
takers. I mean, the private equity industry, there you don't get paid much up front. You get paid on the back end if you do well on the investment. So it has to be somebody that's willing to maybe take a lower base for the upside at the end of the day. And that end of the day might not be for 10 years down the road, and somebody taking a risk and a bet on themselves. And the leaders and management teams of these companies, since they participate in the upside, they're in the very same boat. I mean, a lot of their incentive comp is tied to really growing enterprise value. If they're able to grow enterprise value, they get paid really well, really well. And at the end of the day, when we sell the businesses, they do even better. But if they don't perform and they don't um, create value, their pay is less than they would make at saying working for a large company or a public company, something along those lines. So it's got to be somebody that's very confident in their own ability and a bit of an entrepreneur themselves.
mm. How about what practice or how do you think about and what practices do you employ for to ensure the ongoing growth and development of employees to
Yeah,
the
I mean it's
extent?
con
Yeah, yeah.
yeah, it's constant learning. I mean, we're a small firm, so it's not like we have um, training academies and all the stuff
Uh-huh.
that the bigger firms go into. But I'm a huge reader. I read everything out there and listen to a ton of podcasts. I think it's a little bit on the employee that they have to take on that education themselves. I mean, we do go to conferences and trainings and all that kind of stuff. But I think, I mean, you just have to be a constant learner. I mean, the best lessons we learn are when we go out and meet with these management teams, meet with these companies, even the companies we don't buy are doing really well. You learn something every time you're talking to somebody. So just be a lifetime learner and read everything that's going on in the private equity industry and really across the board.
Yeah. You've talked about a lot about, relationships and the importance of that in investing, but any strategies or maybe even go deeper on that that have proven most effective in identifying and capitalizing on these high growth opportunities?
Yeah, I'd say when most of these family businesses, they're very happy. These families are making a lot of money every year. They're living good lives. They're really not focused on growing those businesses because that takes on a lot of risk. It takes on more working capital, or they have to take on debt to in order to grow those opportunities. So when we buy a business, there's probably 10 or so low-hanging fruit, like easy things to do to really create some value or grow that business. And all 10 of those have some risk associated with them. And I'd say that the biggest thing is not go after all 10 of those. You need to pick
Mm.
one, two, maybe three really high value areas and focus on that. And these businesses, they don't have a lot of resources. So, I mean, you can't spread them too thin or nothing gets done. So I'd say that's the biggest lesson is instead of kind of identifying 10 value creation areas and trying to do it all. Just pick one or two that are really going to move the needle and execute on those.
What what's maybe been one of the biggest challenges you faced while building either your firm or one of your portfolio companies, and then how did you overcome that?
Yeah, I mean, we built the firm over the last 10 years, so there's been a lot of challenges.
Yeah.
We never expected COVID and everything that
Oh
came with
God.
that, and it's constant. It hasn't stopped. Every year, I feel like the teens were really a calm decade. There wasn't a lot of uncertainty. I mean, once we got through 08, 09, 2010, the next 10 years were pretty good times for private equity. Unfortunately, we launched in that period. Financing was easy, rates were low, lots of businesses were selling. They'd been through the 08, 09 period. Their expectations were low and it was great time to be investing. And then you run into COVID and really the sky was falling. Just supply chain, people, you name it, was a challenge, and that has not stopped. The last 5, 6 years now, there's something every day. I mean, we're dealing with the fuel costs right now from this conflict in Iran, and every week the prices are going one way or another, and pricing all that in is just it's just a challenge. I feel like that's just part of business now. You just have to expect unexpected, focus on what's within your control, and do whatever's in best interest of the business.
Yeah, yeah. How about, I mean, so, name of this podcast, Capitalist Culture, and in what ways has embracing our capitalist free market system benefited your business model?
Well, private
Ha.
equity is probably the best benefit of capitalism out there. I mean, it's in my Borgman Capital is capitalism.
Uh-huh.
101. I wish everybody knew kind of the magic of capitalism and the secrets. It's really if you have access to capital, and there's a lot of it out there, you can do really well. So I've been very fortunate myself. I didn't wasn't born into it. I was raised by a single mother that dropped out of high school, so she didn't have much choices. She probably didn't even know what capitalism was, but fortunately, I did well in school and got a good degree and kind of lucked into it. And if you're inquisitive and you enjoy learning, I mean, learning about capitalism is probably, I mean, we're very fortunate to live in the country that we live in with this free market enterprise and as much access to capital as we have. I mean, I know we just celebrated our 250th anniversary, but that's really a blessing to all of us that have access and know how to use those and pull the levers and that's something I wish I'd known earlier in my career is how how available capital is here in this country.
Yes. Any ways that you advocate for capitalism and free enterprise, like outside of your direct business activities?
Um, Yeah, I mean, outside of our activities, I mean, there is, I mean, where we are, I wish there was more education around it,
Mm.
especially earlier, maybe middle school, high school for those coming up, to really learn about more about economics and capitalism and the benefits of the free market that we live in. So yeah, I think in the education, I wish there's more entrepreneurs that like if looking back, I mean, we look at these businesses where these entrepreneurs are making $4, $5, $6 million a year running a electrical contractor or HVAC contractor or a plumbing contractor, and they didn't go to college. They just went into trades out of school. And I wish kids knew that if you're ambitious, you work hard, and you go into something like that. And I mean, you build one crew and then two crews, and before you know it, you're running 10 crews and you're making millions of dollars a year in something that they really don't teach you about that in
Mm.
high school. Those are very, very successful individuals, and it's great. And at that age, when you're coming out of high school or college, I mean, you have a lot less risk to start something entrepreneurial. I mean, what do you really have to lose? You don't have kids and a mortgage and all everything that comes with that at that point. And if you fail, then you just go get a job. That's kind of your fallback plan. So I wish there was some more focus on ism early in people's life.
Yes, yes. How about looking back, I don't know, any particular decision or action you would say that's proven most pivotal in your success so far?
Yeah, I think our biggest success is we just hit the ground running. We were successful off the bat. I know a lot of people that start firms or go out and try and buy a business, and it's tough. It's very competitive. There's a lot of buyers out there. And if you don't find something in the first couple of years, you tend to run out of capital and then you go do something else. We were fortunate that we were able to find some really nice investment opportunities within that first year and hit the ground running and really haven't looked back since.
That's awesome. How about any advice you'd give to either young or aspiring entrepreneurs on how to succeed in today's economic climate?
Um, I don't know if there's advice. I mean, every entrepreneur has been successful kind of for a different reason, but I just say outwork your competition, don't give up. I mean, the entrepreneurs that are successful are the ones that didn't give up. Times are tough. Running a business is extremely difficult. It's probably one of the hardest things you can do. You put in way more hours than any job that you'll ever work as an entrepreneur. You've got to love it and don't give up when things get tough because every business owner out there has had tough and difficult times and had to make really hard decisions. I mean, you have to constantly think about what's in the best interest of that business and for the long term. And sometimes that impacts people's lives and their livelihood, and that's not easy as an entrepreneur. So again, just hang in there, work through it, and figure it out, and keep going.
Yeah, just don't stop. I always think of the Jerry Maguire line, just it's now but dawn, pride swallowing siege. You just keep going. You just keep going.
I, I was thinking of Show Me the Money
Show me the
one,
money too.
that one too.
Oh, for sure. How about I don't know, any future trends, opportunities, things that you are most excited about, and then perhaps how you're positioning your firm to benefit from that?
I think, and everybody's focused on it right now, but I think AI is the pretty most exciting thing here on the horizon, and just how it's going to create some value in these businesses. We're on the front side of it. Everybody's looking into it. Everybody's adopting it, using it. It's making their lives easier, but it hasn't quite got to the point where it's creating real enterprise value. And I think that's right around the corner. So I'm excited to see where that goes.
Yeah. How are you guys thinking about it or using it so far, either within the firm or portfolio companies?
Yeah, we're using it within the firm. I mean, I use it every day. It makes my life easier. All our analysts and everybody are using it to analyze businesses. Um, and the portfolio companies, I mean, every single one of them we have looking into ways to adopt AI and either simplify their AR, AP, a lot of finance functions, but also quoting and sales functions. There's a lot of stuff that AI can do a better job than the systems that are currently in place, and we'll see where that goes.
Yeah, yeah. How about I don't know, any of your deals that have been maybe not the best, but or maybe the most successful or most memorable or most fun that you've worked on so far?
Um, They're all fun in some way. I mean, they're like children. So you said you have three kids, so you know how it kind of you always have a favorite child at every different point. So
That's the
and
truth.
I'm a numbers guy, and my number one responsibility is to our investors. So the companies that are doing great, those are my favorite, and it tends to be a different one every quarter, a different one every 6 months, different one every year, and they all go through challenging periods too. I mean, that's difficult. I mean, you do everything you can, like I said, do the right things, get things back on track, or replace the management team if you have to, and get through that challenge, and that's you all dig in and you spend the time to get through it. Just like the advice I gave the entrepreneurs, that we take that advice to heart. So. But I'd say they're all different challenges, and the ones, I mean, I said it again, and you're in the people business. It's really the people are the biggest challenges in these businesses. I mean,
Right.
these businesses would be really easy if you didn't have to deal with the people part of it.
That's the
Uh,
truth.
so that's probably least fun about the industry and what we do is really when you have to make decisions that impact person's livelihood and their family and everything along those lines.
Yeah. How about kind of last question here, success? And you can take this any direction you want. What's your personal definition of success for yourself?
Yeah, I mean, like anybody, we set goals and when we achieve them, those are great. But we're always looking at the next deal, the next opportunity. You get really attached to these businesses when we sell them. That's sad. I mean, even though it's a
Uh-huh.
very successful, for my wife's always very happy when we sell something because we get some money back. Our investors are happy. Everybody's celebrating, but it's really a sad point because I mean that's a business that you've become very attached to. You spent a lot of time thinking about that business, and you're handing it off to somebody else. So it's kind of both sides of the coin. You're happy for the success in that sale, but also sad that you're no longer involved in that business. And I'm sure the sellers that sell to us feel the exact same way.
Hmm. Yeah, I mean, to use your analogy, it's like your children, and you've poured into them, and now you've setting them free to go off into the world.
Yeah, exactly. I mean, you spent years and years and years with those employees and with those businesses and customers, and then to have to pass it off to somebody else is really hard.
Yeah, no, for sure. Well, Sequoia, this has been awesome. I really appreciate your time and insights and sharing more about Borgman Capital. And we'll share in the show notes how people can get in touch with you, learn more about the firm and what you have going. But thank you again. This has been an absolute pleasure.
Yeah, thanks for having me on the podcast.
Absolutely my pleasure. Thank you.